Welcome back, my name is Arya and I don't waste your time, so let's get straight into it. Ladies and gentlemen, in today's video, we're going to be talking about a company that I could safely say has absolutely revolutionized the world and has completely altered the direction of your lives and every single person that you know. We're going to be talking about Taiwan Semiconductor Manufacturing Company, otherwise known as TSMC, which is at the time of this recording the 8th most valuable business on earth, sitting just shy of $1 trillion of market cap. So in today's video, we're going to analyze TSMC from both a qualitative and a quantitative perspective to try to determine whether this is a company that can outperform on a going forward basis. And at the end of it, we're going to jump over to my valuation spreadsheet to try to determine whether this company is priced accordingly with the amount of growth that you're getting. For starters, just to kind of set the stage and what it is that TSM does and why it's such a wonderful business, Taiwan Semi, as the name would suggest, is engaged in the production of various different semiconductors. And semiconductors, I'm sure many of you guys are familiar with what those are. It's the chips that goes in all different technology devices around us today. So they make chips from the most basic things that go into your toaster and your fridge and your oven in the kitchen, all that type of stuff, all the way to the most advanced chips that are used in NVIDIA H100 chips to train AI models, so on and so forth, right? Or the chips that are incorporated in the monitor in front of me, the PC that I'm running this recording on, so on and so forth. Now, to give you an idea on the market share that TSM has compared to its peers, I was able to get this chart from a Forbes article. I'm going to link it in the description if you're interested in reading the whole thing. And this is a little bit dated and it is sorted by geography, but it really does key you in on the type of chips that Taiwan is specifically making. Taiwan in the pink here, which is mostly just TSMC, they have roughly a 92% market share in the logic semiconductor space. And the logic chips, these are your most advanced chips, right? This is below the 10 nanometer threshold. And these are the chips that go into iPhones, MacBooks, computers, all that type of stuff, right? The most advanced chips that actually need a lot of compute power and need to be able to process a lot of information. But as you can see, they do have presence in other segments of the market. So like memory chips and all that type of stuff, which is these are more like to cater towards your toasters and your calculators, just the basic chips that are required in the world. But nonetheless, they do have presence across the board. But again, as you can see, it is the more advanced chips for TSM. Now, you guys are probably sitting there thinking, Arya, what's so special about this business? Why is it even like the 8th biggest company? Sure, it has a lot of market share. Sure, the world is ran on chips, so on and so forth. But the brilliance of this business lies in the fact that it has one-of-a-kind scale in its industry. So they do have roughly 50% market share in their respective industry. And in the past, that has translated to having massive scale over its competitors. TSM has by far the largest footprint out of any different chip manufacturing company in the world. And because it has the biggest scale in this industry, that has allowed TSM to be able to drive customers away from competitors and win over their business. In an excerpt from Morningstar, which is a research firm that I like to include in my videos, they mentioned, "We believe TSM's wide moat is justified by a wider gap between itself and smaller peers. Because of technical hurdles, node advancement has been growing more costly, prompting some smaller players to give up catching up with the industry leaders and other firms to divest." So essentially what they said there is because TSM is so big and they have massive amounts of scale, being able to continuously win over business from massive clients such as your Apples, your Amazons, Microsoft, so on and so forth, NVIDIA, all these different big customers, they're able to gain access to the most amount of resources as a result of this. And because of that, they're able to dump the most amount of capital expenditures back into the business, building more and more factories, thus being able to increase their footprint, building more production capabilities, and thus the virtuous cycle begins all over again. So, to summarize, this is the age-old scale economies, Jeff Bezos flywheel. Because they have the most customers, they have the most access to the resources. Because they have the most access to resources, it creates this continuous loop of them reinvesting back into the business, continuously being the biggest scale player. And this is what scale economies is all about. Scale economy says that the biggest scale player tends to be the winner of their respective industry because they have the most access to resources in their respective industry. And we could see this because even Morningstar makes a mention here. While there were 6 companies with cutting edge nodes when the industry introduced 16 to 14 nanometer chips, so this is roughly the 2015 timeframe, there are currently only 2, TSMC and Samsung Electronics, selling 5 nanometer chips, right? So today, the 5 nanometer chip market and below is the cutting edge. Meanwhile, in 2015, there were roughly six different competitors. So over time, you're seeing that less and less companies in just the chip manufacturing industry are able to continuously provide the cutting edge chips because it has become so costly to be able to build these factories out and stay competitive in the industry. And as it stands currently today, there's only TSMC and there's only Samsung that are able to actually make the cutting edge chips that go in the fresh new iPhones that come out every single year, or the NVIDIA H100 chips, right? And then just under this paragraph, they say something which I think is paramount to understanding about this business. They say multiple technical barriers and high capital requirements form TSMC's wide moat. That's it. That's the moat right there. You need so much capital to be able to build these factories that it doesn't make sense for any company on earth to build these factories out unless your name is TSMC. And another brilliant thing, which I wasn't able to find in this Morningstar report, was the fact that TSM themselves, they actually only manufacture chips. With other competitors in the industry, namely Samsung and Intel, they actually not only manufacture chips, but on top of that, they also design their own chips. Now, you guys might not think that's a big deal. If you're Apple and you're giving your designs away to Intel, and Intel just can look from 0 to 100 and be able to see that, oh, Apple was able to drive efficiency using these 10 tactics, whatever. Oh, we should copy that, put it in our Intel chips that we also own. That's a pretty big problem for Apple. You're giving all your research and development away to Intel for essentially free. Now with TSM, they don't actually design any chips. There is no TSMC Intel i7, right? Like there is no branded TSMC chips that go in the computers and so on and so forth. So for all these different companies that only design chips, it completely makes sense for them to go with TSMC and give their designs to TSMC because they know TSM isn't going to backstab them and take their designs and make their own chips better, right? So there is no conflict of interest between giving your designs away to TSM, while with Intel or Samsung, if you're getting those companies to manufacture your chips, there's a massive conflict of interest when you're giving your designs away to them, right? And this is the reason why Apple, roughly 4 or 5 years ago, actually switched away from Intel and went over to TSM. And TSM actually brags about winning over Apple because it's like the biggest customer you could possibly win over. So to kind of recap here, we have the biggest scale player in probably the most lucrative industry on earth. They're just shy of $1 trillion in market cap. They have 50% market share. And the way the industry is moving, it seems that TSM is going to continue winning over business because they, quite frankly, benefit from unfair advantages. Being a manufacturing-only business, and then on top of that, having the largest footprint of factories around the world, makes it so that you have the biggest capability of actually meeting this chip demand globally. Now, you guys are probably sitting there wondering, Arya, this sounds like the most incredible business, which honestly, I don't disagree with you. This is probably one of the premier businesses in the world today. Now, there is a couple risks to worry about with this. Of course, with most of these like mega cap companies that are just essential to the world, there isn't that many risks. But for TSM in particular, there is a couple that honestly, it's probably things to watch. First and foremost, TSM operates in the semiconductor industry. Now, I'm not sure if you're familiar with the semiconductor industry, but it has historically been massively cyclical, where you're seeing a boom in demand because of new technology, new efficiencies. 4G just came out, or the new iPhone cycle just came out. We're moving to mobile. We're moving to the cloud, right? So it's been massively cyclical with boom and bust of there's 4 years of incredible growth and followed by 3 years of just semiconductor winter because they overbuilt on capacity. And we're in the middle of the rise of the next wave, which is of course the AI cycle. Now, of course, it has been incredibly cyclical, and when we jump over to FinChat to look at the fundamentals of the business, the revenue of the business also is evidence of this. So that's something to watch. It is cyclical, like you might have like a year of 20-30% growth followed by negative growth, so on and so forth. Another thing that Morningstar talks about is the client concentration risk. Apple has been the biggest client of TSMC, roughly about a quarter of their revenue for the past like 4 or 5 years. If Apple decides to move for whatever reason, I don't think it will ever happen. Probably in the next like 10, 20, maybe even 30 years, I don't think Apple's moving. They moved from Intel, which was justifiable, but no one is going to be giving Apple a good enough proposition for them to move. But nonetheless, it is something to watch. If Apple decides to maybe, okay, a little bit TSM, a little bit some other competitor, that is something to be worried about, right? With having a big client make up a large portion of your revenues, that's always a risk to consider regardless of what business you're in. And then on top of that, a little bit more worrying is that the top 4 clients actually make up half of revenue. If you're going to be losing one of those top 4 clients, that is something to watch. And then one last glaring risk factor that is not included on the Morningstar report, which I think they're doing that because they're trying to avoid politics in general, but it is the geopolitical risk that TSMC faces from being located in Taiwan. Now, I'm not going to dive into all that because I don't really do the whole politics thing, but that is something that you yourself, you should do your homework on and see if you're comfortable with that before investing in a company like this. That is something that can materially affect TSMC and honestly materially affect the entire global supply chains. Now, jumping over to FinChat to take a look at the fundamentals of the business, because sure, you could have the most incredible competitive advantages and the most incredible moat around your business, but if you don't have the fundamentals to back it up, then it's not worth your investment dollars. So, for starters, the margins of this business are absolutely fantastic. 53% gross and 42% operating margins. 42% operating margins is right up there with the greatest businesses that we have on earth, such as MasterCard and Visa. More so MasterCard than Visa. Additionally, taking a look at the growth metrics of this business, both on a trailing basis and a forward basis, we can see that it's expected to grow revenues and bottom line profits at over a 20% clip over the coming years. This is an incredibly capital intensive and asset heavy business, but nonetheless, it doesn't lack on the capital efficiency metrics. ROCE is roughly in the 26% range, and this is not a levered business. They have 80 times operating profit to interest, so they could pay their interest expenses 80 times over. They have more cash on the balance sheet than they have debt. So again, not a levered business, incredible margins, they don't lack on the return metrics, and they have a lot of growth left in the tank. What valuation do you think you could get this business out of? If you've looked on the screen, you could already see, you could go out and buy as many shares of this business as you possibly want for a mere 28 PE. Now, I don't know if you know, but the current PE ratio of the S&P 500, the combined entity that is the S&P 500, is actually identical to TSMC today. It's roughly at a 27, 28 times multiple. So you could go out and buy as many shares of the S&P as you possibly want for the same multiple that you could buy one of the greatest businesses that the earth has ever produced, TSMC, that is growing double the pace of the S&P 500. That is operating margins that are likely 2 to maybe even 3 times higher than the S&P 500. And let's not even talk about the balance sheet of this business compared to the S&P 500. I'm sure the average entity that is the S&P 500 has a significantly worse balance sheet than TSMC. So again, I'm starting to kind of paint a picture here that this valuation isn't really that lofty, even though this company is at literal all-time highs. Now, maybe the discount in valuation is the whole cyclical thing, right? Of course, the chip industry has been massively cyclical, so the market is maybe discounting the fact that, you know, these revenues are not as sticky, they could come and go, so on and so forth. But if you were to look, and we could expand this on FinChat, they have a feature where you could see the analyst expectations. This isn't in dollars. Here we go. That's in dollars. So again, you could see that, sure, there is years where, like, for example, between 2022 to now, like, there is years of stagnation. And over here in the 17 to 19 timeframe, you can see that it wasn't growing as much, but you could see the cyclicality play on the revenue chart. Sure, there's years of like where it just stays flat, but then you see a massive boom cycle of companies building out a lot of capacity and demanding a lot of chips. And I think we are at the early innings of the next boom cycle with the whole AI thing. Now, one last thing to note before we jump over to my valuation spreadsheet is, one, this business does absolutely no stock-based compensation. You can't even see the red bar here. That's how little in stock-based compensation this business does. But on top of that, as you can see, they have a lot more operating cash flow than they do free cash flow. And the reason why that's important is because, of course, as we know, in order to derive free cash flow, you simply deduct the amount of capital expenditures or the investments into hard assets that this business does. Of course, this is a very capital intensive business. They're building lots of factories all the time, and they're doing maintenance on those factories, buying big lithography machines for hundreds of millions of dollars. So when you look at free cash flow, it's a little bit handicapped compared to looking at the operating cash flow of this business, which I think represents a more accurate look of the true cash flow producing ability of a business like this. I also look at similar things for Amazon. So at any given time, you know, they could just cut their CapEx budget in half and be able to produce a record amount of free cash flows. But of course, they will continue to scale and build more and more footprint and capacity to be able to continue building lots and lots of chips and be able to maintain their lead over their competitors. Nonetheless, this is something to note. The free cash flow of a business like this is almost always going to be handicapped. As you can see, they are expected to do roughly $20 billion of free cash flow in full year 2024. And if we were to jump over to my free cash flow to growth spreadsheet that I include in every single one of my videos. Long story short, what we're doing here is we're taking the current valuation of this business and we're dividing it by how fast we expect this business to grow to be able to determine whether or not, for the amount of growth that we're getting, this is a company that is worth our investment dollars. And if you were to take a look at TSMC over here, and we are doing this in cash flows, by the way, I put roughly a 20% growth rate down. And the way I was able to get that is because I simply looked at the earnings per share growth that is expected for the coming years. And I'm just putting that as like kind of like a placeholder just to see where it roughly ranks. Of course, with free cash flow, as I just described, this is not a perfect fit because at any given time they could do a massive ramp and big CapEx cycle. And at any time they could cut that CapEx. So again, roughly 20% growth rate on $20 billion of free cash flow in the coming year. You land at roughly a 45 times price to free cash flow multiple for this business. Now it's about fairly valued based off of my spreadsheet. Now what's important to note with this is if you change around your assumptions with this method of valuation, you could get drastically different results. If we simply bump up the growth rate of this business a couple percentage points, you could see that all of a sudden it's it's undervalued for the amount of growth that you're getting. So again, this is a lot more art than science. And I think what's more important to look at with a company like TSMC is the cash flow producing ability of that business, which is determined by the operating cash flows of the business, as opposed to how much free cash flow is actually able to grow. This is something that I did with Amazon when I first started investing in Amazon. It wasn't producing much cash flow, but I had a very high conviction in the fact that it's able to produce cash flows in the coming years. And at last, if you like the fact that I don't waste your time, I'm going to ask you to do something that costs you nothing. If you hit the subscribe button, I'm going to continue to post high quality videos just like this one. And you can always go back on that decision if you end up not liking the videos, but I highly doubt that. Thank you for watching and have a great day.